Hey there, folks. This is Mitch Firestone with Precision Trading Labs. It is August 12th, 2022. I want to show you here a couple of things. First, a recent chart of a trade that we had that's a great illustration of the supply and demand concept that we utilize to create high probability setups. And then to go through a quick market summary of where we are and, in a sense, how it might set us up for next week. Okay. Before I get going here, of course, Precision Trading Labs, we are not financial advisors or broker dealers or anything like that. But we are simply here for education and for giving people comfort in terms of setting up, learning how to trade, learning key concepts of how to trade in terms of creating high probability risk controlled setups. So everything we present, of course, is for educational purposes only. So anyway, here is what I wanted to show you here. We're actually looking right here at a setup that I had presented to our subscribers. I guess this was on, let's see, on basically right at the end of July here. And this was on the 22nd, in fact. So at that point, we had noticed that in this 2-hour chart here, that looking at Qualcomm here, there was this launch point of a very, very strong move here. And so at that point, we were looking at this. We noticed that there was this period of this little point of consolidation before there was before there was a gap, and then this basically string of green candles, many of which were very energetic, leading up to this. So this strongly suggested that there was an imbalance that got created between willing buyers and willing sellers right at this point. And so at that stage, then we're now waiting for a return or a retracement back to this level, where we're expecting that there was some residual upward price pressure here in order to get long right at this point. So this was the setup. And so our entry was going to be basically at 142 even, because this is how the candle laid out here. And then we basically again gave it a stop, $2.25 beneath that. It was actually a little larger stop than we would normally do. We would actually normally put our stop kind of right behind the level, right behind the bottom of this level at 140.80. So we might have actually been inclined to do that maybe just a little above 140, maybe 140 and 50 cents. But the point was, because of the presence of the round number of 140, we decided to be a little more generous with the stop, and to basically give it a little more room, because of course market makers and traders, they like to go stop hunting at round numbers. So the fact that the round number was sitting right, this zone was sitting right on top of the round number, we figured we would give it a little more room. And so that's the reason for the stop here at 139.75. So at any rate, this is how we this is the trade that we had planned out here. And of course, there were the way we work it with our subscribers. We always present at least two different ways to express the trade. One obvious way to express the trade is simply to go long with the stock itself, so buy Qualcomm. Okay. The other way, of course, of getting basically of expressing this bullish trade out of this level would be to buy a call. And at that point, then we also then had the suggestion here by the October 21st 145 strike. So this is going to basically be the strike. So we were going to be buying this just a little bit out of the money. Our normal preference is to buy it within the money, or even a bit in the money, I should say, so that we're generally running a delta of, let's say, 55, 60, somewhere in there. But because of the fact that this option was a little more expensive, we actually tried to keep the premium at $10 or below. And so consequently, I don't recall what the number was, but I think the premium on this to buy the 140 was going to be something around 12.50 or something. And so as a result, we decided that we would then present this, use the 145, and this was going to be about 11.50. In fact, now that I think of it, I think the 140 was actually going to be significantly more than that. It was going to be about 14.50, something like that. And so as a result, we were going a little above with the $10, but we decided to go with that anyway. So at any rate, that was how that was the setup that we were looking at least at the time, where we saw what the premium was. Okay, so anyway, we're waiting for the pullback here in order to go long. Okay, so if we now flash forward to the live chart here, okay, there was our setup. There was the actual pullback of what we got here. And so at that point, then we ended up getting a nice bounce out of here. And at that point, then we actually were in the trade, I think, really just kind of about 2 days. The pullback occurred on the 29th of July. I think there was a week, the intervening weekend, and we got out on the August 1st. So we were in this thing really just for a couple of days. So when we actually got in, the premium had actually dropped, and it was the fact that when by the time price pulled back here, between the fact that the market was sort of in a recovery mode here, implied volatility within the market had kind of some of the fear and apprehension, at least for some point, had come out of it. And so as a result, when we actually got into this trade, there was actually the premium was about 915 at the 142. And so that's where we got in. And then by the time it came out, the premium then was 12.90. So for the option, we made $3.75 on that bounce. Um, and so that represented just a touch under a 30% return for the 2 days that we were in. So not too shabby. And of course, if you simply went long on the stock, well, then you bought it again at 142. You got it out. You got out at 148.73. So of course, that's a $6.73 move on the stock. Okay, so obviously for every 100 shares, if for every 100 shares that you bought, of course, on this, you would have been up $673 on the gain where we got out. And if, for every contract, for every call contract that you bought, you would have been up $375. Obviously, the 375 is a lot less, of course, than 673. Having said that, of course, needless to say, the rate of return, though, using the call, obviously was significantly greater than buying the stock. But either way, of course, is a good way of making the money. And of course, if you're buying the stock, you're not necessarily getting into the complications of the option. But on the other hand, we are well rewarded for doing that for using the call here. So at any rate, that was that trade. So that was kind of cool. And now what I wanted to do now is kind of go through a quick review of where the broad market is now. Okay, so at this point now, let's see here. So here's the SPY, and we're going to look at the SPY here, the S&P 500, which of course is your major broad market indicator. So we're going to use the SPY here to sort of as a proxy for the broad market. And so we can see, uh, just historically, right back here, pretty much at the beginning of 2022, we had reached this major, or in fact, this was, I think, an all-time high here. We had reached this major high back here, okay? And that was at, again, the very beginning of the year, and that was a touch under 480, okay? So at that point, then, we had hit that major high, and then at that point, we started to sort of swing. We were creating these lower highs and lower lows. Okay. And then at right about this point right here, um, this was actually a 10% drop from where we were at that high. Okay. So at that point, that was a technical correction we had gotten into. And in fact, right here, of course, we had hit these correction points as well. So 10% below that, which is one fourth, basically call that 432 versus 480. That brought us into correction territory here. Now, the first time we hit correction territory, we immediately bounced. Second time we went back to it. Again, we were there for a relatively brief amount of time. There was some recovery, and then finally, in the very end of April, we then kind of hit that correction, and then and then we've ever since then we've been there. Okay, and then at the fact that about a month later or so, we actually then hit right here the 20% mark down. And that's technically, of course, by the classical definition, that's a bear market. Okay. So 20% off of that major high here, that's a bear market. The first time we hit it, we immediately bounced off of that. Probably some market algorithms kind of kicked in there, and they just really weren't ready to take us into a bear market then. But then after that, a second shot down, um, we then actually we actually entered a bear market here. You can see we obviously entered this bear market in earnest. We obviously had this string of bearish candles separated by these really, huge gaps. Okay, so this was a bear market with a vengeance here. Okay, so we obviously dropped down into this right there. There's our 52-week low that occurred. What is that? That's about mid-June or so. So there we in fact hit our 52. That we had hit our low on June 17th. Right there was the 52-week low. We then recovered and then kind of, bounced up and down, and then, basically pretty much staying in bear market territory. But then at this point, then right when we reached this level at around mid-July, July 14th to be precise, uh, this week's kind of like another higher low. So we made a low here, there was a high, there was a higher low, and then from then on, we've basically been pretty much a rather robust upswing here. Okay, right here there was a little pullback here, pretty minor, but right here, so basically this is a high, higher low, and then there's a higher high. So we're essentially we're sort of in an unconfirmed uptrend. The reason it's technically unconfirmed is we want to see, in a sense, one more higher low. Um, but really, but by all metrics, though, we really are obviously in a robust uptrend here. And in fact, shortly, we're actually only about $7 away on the SPY to actually then getting out of correction territory here. Again, there was that 10% drop off the high, which was around 432. We're sitting here at around a little under 425 here. So we're about $7 off of erasing the correction status of the market. And in terms of a percentage, that's just a touch under 2%, about 1.6, 1.75%, something like that. So we have about that another 1.6, 1.75% to go or so. And if we take out this level here, then in fact, we are now out of correction territory as well. And at this point, then, right here, this is an area where we might conceivably see some resistance. This is kind of a sloppy area of supply here where we might actually see the market kind of get smacked down a bit here from this level here based on the evidence of this prior move here. We'll see when it gets there what happens. At any rate, right here really is an area again where we're about to get out of correction territory. So what are we looking for here? At this point, right in here, there is an area. We can kind of consider this to be an area of potential demand here. We need to kind of see this price kind of move up a bit more. But if we do, somewhere in here, there is probably an area that if we get a pullback, there is an area of upward price pressure where we can actually look for a pullback into here in order to then go long. And so what we're going to be doing next week is kind of planning for that. We'll kind of examine this in a couple of different time frames, probably drop this down to a 2-hour chart, as well as bump it up to a weekly, and kind of see what we find inside of here. But I'm pretty confident we're going to find something in here that's going to represent something where we can actually get, if we have a relatively moderate pullback, regardless of whether we go into whether we break out of correction or not. If we do get a pullback to here, I'm pretty confident that we're going to find some level that we're going to be basically utilize for another bounce. And then on top of that, in addition to looking at the SPY, we will obviously then also look at the various sectors. And what we'll do is we will identify sectors that are showing the greatest relative strength versus the broad market. And then we'll look for similar levels in those sectors in order to then see, in fact, if we find pullbacks into levels that probably look somewhat like this, we can then utilize either the ETFs associated with those sectors or strong stocks within those sectors in order to go long as well. And of course, then once we say we're going to go long out of them, again, we can certainly look to express the trade either by buying the stocks themselves or utilizing calls or any number of other bullish strategies. But they will all be based on the pullback into these zones here where we are expecting to find pockets of future upward price pressure. So at any rate, that's what I got here. So I'll leave you with this, though. Here is our website here. If you go to www.precisiontradinglabs.com, and if you enter your email address, you'll be able to download our free report, as well as that'll give you access to other free content that we will send to you. In addition, it'll also give you the option to reach out to us, and we can actually talk to you about the supply and demand concept and how that can be utilized to construct high probability risk controlled trades. So at any rate, that's what I got. This is Mitch Firestone with Precision Trading Labs, and I will see you next time. Take care.